There's an irony there in that the greatest trading firm in history was started by someone who didn't come from Wall Street, didn't go to business school, didn't read Buffett and Lynch and all those kind of books that I read and other people read growing up. He was a mathematician.
My guest today is Gregory Zuckerman. Greg is a special writer at the Wall Street Journal and three-time winner of the Gerald Loeb Award, the highest honor in business journalism. Last year, I had Greg on the podcast to talk about his latest book, A Shot to Save the World, the inside story of the life and death race for COVID-19 vaccine. Since then, the book, A Shot to Save the World, was longlisted for the FT McKinsey Business Book of the Year Award. Today, we'll be discussing The Man Who Solved the Market, how Jim Simons launched a quant revolution. The book has more than 2,000 five-star ratings on Amazon. I recently sat down with Greg and we talked about the unbelievable story of a secretive mathematician who pioneered the era of the algorithm and made $23 billion doing it. Greg, great to have you back on the show. Thanks so much.
Great to be here.
Greg, I want to tell you, you are the only guest that ever had a second appearance. So congratulations on that.
It's an honor, privilege.
All right. And I want to tell everyone why. I have been a big fan of yours for years. I started reading, I think it was 08, 09, maybe a little, I forgot when you wrote the book, in 10, The Greatest Trade. What year was that? 10?
That was 2010 it came out.
2010.
2009 hardcover, yeah.
Great. I read that book, loved it. About John Paulson and The Great Trade, The Greatest Trade, where he made $20 billion or so. Was that
just $20 billion?
20, all right. It kind of sounds small in the perspective of time. But okay, so you had that. Then your next book, I think was, and I think I'm reading this I'm giving them right order, was Frackers.
Yep, The Frackers. And
then you had this book, The Man Who Solved the Market, which on the last show you were on, we talked about your book with the COVID vaccine, how that works. I forgot the title, A Shot
to Save the World.
A Shot to Save the World. And when I had you for that book, I said, I got to have you on again because this really is fascinating. The name of the book, folks, and you're going to really love this show because this is absolutely amazing. The name of the book is The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. So everything you know about quants and quant trading, and we'll get into all of that, it was started by this guy here, and his journey wasn't a straight line. Jim Simons is worth, what was he worth now, 25 million, 23 million, something like that?
Billion, no, not million.
I'm sorry.
Insult him, yeah.
Billion, yeah.
25 billion or so. He's given away a lot. He's given away over billions of dollars, but he's still worth about 25 billion.
Yeah, $25 billion. And his story is just fascinating and how he was one of the first out there and how he really revolutionized trading. And more importantly, he's been able to extract, I think it was 100, I don't know how many, you have it in the back of the book, $100 billion plus out of the market. Is that right?
More than that, yeah.
Yeah,
more than that.
Right, just from 2018, just the medallion fund, I think you have here, was 2018, $105 billion in trading profits. That doesn't include the other funds that he had, doesn't include personal, doesn't include a whole bunch of other things. Just from that fund, $104 billion. Wow, amazing. All right, so let's start right from the beginning. First of all, Jim Simons, our audience should know, is a guy who does not give interviews, rarely out there, very, very, very secretive. I mean, like NSA secretive, and you'll tell us why he's NSA secretive. That's his background. But how did you get in FaceTime with this guy?
So it was a challenge, and he didn't really want this book written. He even asked me a few months before it was published if I could not write it. I said, Jim, it's already being published right now. Sorry. For a while, I always wanted to write about him for a lot of reasons. They're the greatest investment firm in history. He is the greatest money maker Wall Street has ever seen. I don't know how you define him. Is he an investor? Is he a trader, a speculator? Whatever it is, he's some moneymaker and the greatest of all time. No one comes close to him. He's averaged his fund, the Medallion Fund, 66% a year in terms of returns. And they've continued. Even in 2021, they're up over 40%. And that's after fees, ridiculous fees that they charge themselves at this point.
So, Greg, let me put this in perspective. So from 1988 to 2021, so we're looking at 22, 23 years. Sorry, what am I talking about? 32 years. 32 years. He is charging most of those years 20% of performance fee and 5% management fee. So 5% just for the money to sit there and 20% which is share of the profits. And then starting in 2001, because he has a phenomenal year in 2000 when the markets go bust, dot-com bubble, he does 100%, 98%. Next year he charges 5 and 36. Then right after that, he charges 5 and 44. Is anyone close to that? 44% of the profits?
No, there have been people off and on over the years who've tried to come close, but then they never keep the returns up, so they have to cut their fees.
Okay, so let's frame this properly. In more or less, Warren Buffett, greatest investor, 1965 to 2018. So mind you, it's a much longer period of time, right? It's more than 50 plus years. Buffett's annualized return is around 20%. Jim Simmons is now, after fees through 18, so it's probably about the same more or less, 40% or close to. That's after fees.
After those crazy fees.
After those insane fees.
About 50% of your returns in fees, yeah.
In fees. So you're looking at someone who doubled, well, look, he's still 20 years on it, but still 30 years is not statistically insignificant. That is just absolutely staggering. Absolutely staggering. And you have George Soros, who did less than that, but he did over a long period of time, 32%. Steve Cohen of SAC, well, formerly SAC, 30% over a shorter period of time. Peter Lynch, 29%. So when you put this up there, these numbers look fake.
Yeah, it's interesting you say that because I always heard rumors, speculation, accusations that Simons and his colleagues were a fraud. And frankly, after Madoff, I started working on a potential story for the Wall Street Journal. I worked for the Wall Street Journal about whether Simons and Medallion, the Medallion Fund and Renaissance, his firm, are making up their numbers. The SEC went in there and looked at them for a while. But there's no evidence of that. They're for real.
And also, unlike a Ponzi scheme, they gave back money to clients. They sent back money.
Exactly. That's what people don't get. I get all the time. Still, my book came out and it did nice, and I keep getting emails. Well, Greg, they're a fake. There's no way they have these numbers. What fraud do they give back money each year? Every year they give back all their profits to their investors and investors aren't even outside investors. It's only their employees. It's Simons and his family. So it's not a way to run a Ponzi scheme when you're not bringing in outside money. Absolutely
amazing. All right. So let's start with the man, Jim Simmons, who's still living. He's 83 or so. And chain smoker, goes to show you, huh? Some people just have good genes. And this guy's a genius, right from the get-go. So take us through how, before Jim Simmons was Medallion, who was this guy?
Sure. So just to give you a sense of his importance, before we begin, he's the original, the OG, as it were, meaning everything on Wall Street is moving towards being quantitative, automated, systematic. About 30% of all trading is done in some systematic way. But he's the original, he's the pioneer, and not just on Wall Street. When you think of broader society, predictive algorithms, all the stuff that governs our lives, Facebook and such, and Netflix, what movie comes up next. He was doing predictive algorithms before they were kind of called predictive algorithms, or just some version of that. And so he really is the pioneer, which is kind of why I wanted to write this book as well. And everybody's kind of followed. And both in terms of the returns, they tried to copy those, but in terms of the methods and the approach. And yeah, that's why even though he didn't want to talk to me, we get back to the earlier question, I persisted and I kind of wore him down, maybe, as it were. And finally, I got a meeting with him to talk about talking, about whether he might talk to me. And eventually I got time with him. So we spent dozens of hours together, and he told me interesting, fascinating stuff. He didn't give me the secrets, that kind of stuff I had to find myself. And that's what you get, some of it in the book. But yeah, he has a fascinating life. So he's originally a mathematician and a scientist. And, there's an irony there in that the greatest trading firm in history was started by someone who didn't come from Wall Street, didn't go to business school, didn't read Buffett and Lynch and all those kind of books that I read and other people read growing up. He was a mathematician and a good one. Got his PhD, was at MIT and started teaching both at Harvard and at MIT. Then he left to go break code for the US government. That was an interesting and important period in his life. And he learned how to build predictive algorithms and how to code, which became really important later on. And then he kind of got antsy. He was teaching, working on his PhD, and he always had an interest in trading. He did some trading, but didn't work so well and was an academic for a while. And he was a groundbreaking academic. I think I should make it clear that in the world of geometry, he goes down as one of the greatest of all time. And he's still seen as a respected, really high, well-regarded mathematician. But he got a little bored, and he also, we're talking like 1978, he also thought there were patterns in the market that most people weren't aware of. And he said, well, I think I can find these patterns.
Hang one second. Let me just back up a sec. So Simmons, he's not your average math teacher. This guy is top of the top. He's an elite mathematician. I think there's some type of proof he made that, what was that? I don't know what it was called, some big math thing. That
a couple that are still very relevant. Yeah.
Yeah, he solved these problems. He works, I think it's the NSA. Is it the NSA breakup?
It was a group, quasi-academic in Princeton that worked with the NSA. Yeah. Okay. And they were going up against the Russians in the Cold War.
So what he's doing here is he is looking at a whole bunch of data, and his job is to figure out the patterns in the data, to figure out what codes are there, what's noise, what's predictive, what's not. And he's using his tremendous math skills and brilliant mind in order to take what seems to be randomness and find patterns. Is that more or less right?
It is. He sensed that there was some kind of structure beneath the market's surface. So to you and I, sometimes it just looks volatile, maybe even random. Some people believe in the random walk. He didn't. It's not to say he didn't believe in market being largely efficient, but not entirely efficient. And he kind of figured he can find there's some structure. And that's what these scientists are trying to do, to find structure where everyone else kind of sees chaos. A little bit maybe like the weather, where, I don't know, to the untrained observer, it seems one day this and one day that, all over the place. Well, he thought there were some patterns like a meteorologist might find, and that others were missing. And he set out to figure out what those patterns were and to trade on them.
Well, hang on one second. Yeah, 100%. I just want to point out to our listeners that he didn't care what the company was. He didn't care what the fundamentals were. He didn't care who the CEO was. He didn't care what kind of widgets they made or didn't make. Irrelevant. He basically said, in that random noise, which seems to be to everyone, which is the price data on a minute-by-minute basis or day-by-day basis, he could crack a code and take from what happened and create a system which can have predictive value based on what happened over X period of time.
So yes and no. That was the goal when he started his firm in 1978. But for a decade or so, even longer, he couldn't pull it off. And he wanted this systematized approach where he could go to sleep at night and it was trading on its own. And yet he's a little bit like, I don't know, you and I to some extent. And when you meet him, he's an interesting guy and he likes trading too. And he kind of came in some days and said, you know what, I think gold prices are going higher. So he was torn between these two approaches, using his instincts and his intuition to trade. And he did that pretty well with gold and silver and some other investments. But he found on an emotional level, it was hard on him. The way he described it to me is, when I made money, I felt like a hero. And when I lost money, I felt like a dope. And it was hard on him. Physically, it was hard on him. His stomach, he was having problems. And he said, I got to find a way to trade that's not using my intuition and my my brain power, and I had to hand it over to a system, to a computer, to do this kind of trading. It took him a while to get it right.
Right. So he sets up an office. He leaves academia, correct? I think it was Stony Brook he's working at.
Yeah, and a lot of people were like, "You're crazy. Why are you giving up a thriving career as an academic, head of a department in math at SUNY Stony Brook, to try to be a hedge fund manager in some little strip mall deep far out in Long Island?" I visited there. It still looks like nowhere close to Wall Street and the canyons of Wall Street. So yeah, he gave it all up, and people thought he was a fool.
Okay, so he goes and tries this, and after a while, it's not only not working, but he looks at it and says, wow, I'm a failure. And he is depressed and lying on his couch. And describe that for us.
Yeah, he's not so unlike others who've gotten excited about trading, have some profits, think they're on top of the world, and then they realize they give it all back. And it's just emotionally hard on the guy. And he goes through a few partners. He has some conflicts with them. These are super smart mathematicians. So his instincts are still to find a systematized way to invest, to find some structure, to hire mathematicians and scientists. He's not hiring Wall Street traders or kids or anything like that. And yet he's having real difficulties, and it's really hard on him. And he's like, I can't trade this way. I've got to find some new approach.
Okay. So he's about to throw it all away because he can't do this. It's not working. Right? I think you described in the book, there's one point where he's lying on his couch and looks totally depressed, where they were concerned for his health.
Yes. Now he's a kind of a king, and people can't conceive of that possibility. But I've talked to people who were there with him at the time, and he was distraught, and they were frankly worried about him. He was so emotionally down and seemed like out. So yeah, it was a very difficult time.
And this is what, 78 or so, 1978?
Even later, even the late 80s, it was a difficulty. He spent a decade or so ups and downs, and it was very emotionally hard on him.
What I find so amazing is that here is a guy who I think is 40 years old or so at the time he starts this. And he doesn't give it 6 months. He doesn't give it 3 months and says, you know what, I'll go throw my application back in Stony Brook. They'll take me in a heartbeat. He could have got a job anywhere in academia. But he sticks it out for 10 grueling years that sucked the life out of him. And he kept at it.
Yeah, I completely agree. And there are lessons for all of us. I mean, I learned about resilience and persistence from him, not giving up, having faith in your approach. And at the time, it's important to remember, at the time, no one was trading like he was, looking for these patterns beneath the market's structure, trading in. It's a little bit akin to technical trading, but it's on a much more sophisticated way. Everyone back then was doing sort of the Peter Lynch approach. Oh, my wife comes home, she has these new pantyhose. She's excited about them. Let me take a look at this company. He buys legs, makes a fortune. He's, obviously Fidelity. And I'm not in any way disparaging that approach. It's one approach. But Simon says, I've got a better one. I think I have a better one anyway.
Right. And it went totally against everyone's thinking, because short-term trading, and when I think short-term, day trading as meaning holding for a day or less, as well as 1 or 2 days, was considered short-term noise. And they're right. It is short-term noise. It seems to be that there's no rhyme or reason why the market will go this way or that way on a very short term. You're talking about thousands of stocks or financial instruments. But he had the balls to go out there and say, there is a way to crack this code by getting an enormous amount of data. I can find it.
Right. That's exactly the answer. What he found was what we call today big data. Back then, they didn't call it at all. And what we call today cleaning data, which means making sure it's accurate. And frankly, I give Jim Simons a lot of credit. He deserves a lot of credit, but he is both a brilliant mathematician, but he's also a brilliant executive and recruiter. And he finds not just super smart people, but people who have original thinking. And he finds a guy named Sandor Strauss. Sandor Strauss was in the computer room at SUNY Stony Brook. He had a dead-end career. But what he was really good at was collecting data and cleaning data, meaning making sure it's accurate. And they went back in history and they said, well, let's go back decades. Let's go back centuries and find data. There's been trading of different various financial products going back centuries, and maybe it's relevant to today. We all think that everything new is under the sun and we've never had anything like this. And they'll argue, well, no, actually, there's some similarities even 50 years ago, 100 years ago, 200 years ago. And they went back, let's say commodity prices, gold prices, et cetera, going back decades. And they went back, and when I say cleaned it, they went to see, well, why all of a sudden is this one day you see this odd price where it goes down a lot or goes up a lot? And sometimes there's a reason for it. It actually moved that day, but other times somebody entered it incorrectly, and they actually cared about this stuff. And that was Sandor Strauss. And they found a guy named Elwin Berlekamp, another world-class mathematician recruited by Simons. And he's really, really good at recruiting. And he's able to persuade you to join his firm, even if you have no interest whatsoever. This is back in the day. And Berlekamp is the one who said, well, boss, maybe we should be shifting our portfolio, our trading to a short-term orientation, like you suggested. And that changed everything for them. The returns started getting better. They weren't competing with as many people. Most people back then, especially, were kind of long-term. And they said, we're going to be short-term oriented. And the whole idea was, using this big data, pumping in it all and looking for patterns in the past, even going back decades, but also trading enough so that you're like Las Vegas, meaning you don't have to get it right more than 51% of the time, as long as you trade a lot. So if you trade really rapidly on a short-term basis, you get it right 51% of the time, you do some other things like leverage it up, you can make a lot of money.
Right. And what I found so interesting about this is that he has a competitive advantage because all of these quants, all of these mathematicians and scientists, they would not step foot in the disgustingness of Wall Street. He approached them on an academic level as from a perspective of, I know the life you're living, I know you're not being compensated well, and I know you love a challenge. And it seemed like his interviews, when they had him further on, they were more like you had to give a dissertation. It was in front of a PhD board in a sense.
Yeah, Charles is fascinating. I've talked to all kinds of people who interviewed with Simons, interviewed with his colleagues, had no interest whatsoever in working on Wall Street. Maybe there was a little bit of a disdain for Wall Street. And these are people from the academic world, scientists, et cetera. And then Simons has a great way about him of saying, well, just come over for the day, spend the day with us. And you might see it as a challenge. And these guys all love intellectual challenges. They're all into puzzles and seeing if they can beat the system and figure it out. A lot of them are gamblers on the side and Vegas and that kind of thing. And then they'd spend a day there and they'd say, you know what, this is intellectually challenging and the compensation could be greater, obviously. And as you suggest, that was their secret. One of their secrets, I think, is that they only hire from the world of academia. They never hire from Wall Street. And as a result, the people there really have no interest in going to Wall Street. So as a result of that, you can share more. And that's one of their true secrets. It's there's a unique ability there to share ideas. People say everyone knows what everyone else is working on. It's an open system, open architecture, the likes of which I've talked to all kinds of firms on Wall Street, including quant firms. And they say, Greg, we would love to do it the way Renaissance does it. We can't have everybody sharing ideas. People will walk away. They'll take the best ideas. But as you suggest, they don't have to worry about that at Renaissance because these are academics. They do so well. They make a fortune. And then once they made a fortune, they're not going to go start another hedge fund. Lots of times they go back into academia. They start a non-for-profit. They're not going to go work for Goldman Sachs. You've just made tens of millions of dollars at Renaissance. Well, I'm not going to go work for Wall Street.
And some of them were so embarrassed by the money they made. They still flew coach. They didn't fly first class. They didn't build fancy homes. They were embarrassed taking money out of the system.
Yeah. So my book is, I'd say, I don't know, 2/3 about how they made all this money. And then the last third is about what it did to them. And in some ways it created a real rift within the firm. Some people, as you suggest, were uncomfortable with all this money. Some are kind of left leaning and more progressive. Others are more right leaning and supporters of Trump, like Bob Mercer. We can talk about him. So it's a fascinating mix. There's also a lesson there in how to manage personalities, outside personalities of all kinds of political opinions and other kinds of quirky. These are all individualists, so odd in some ways. They're all real characters. So Simons, yeah, he's a great speculator, brilliant mathematician, trader, et cetera, but he's also a great manager.
Yeah. to get this talent to go. And I remember that you have stories in here of people driving 24 hours or 20 hours from Boston through storms to come to see him in their broken down cars. And they have the interview, and I'm not going to do this. I'm not going to do this. And they sit down with him and they talk, and wow, this is interesting. And by the way, he's such a good. He really has a good take on the human character. He knows what buttons to push. These people were barely feeding their families, some of them, on a professor's salary. And he just suggests, wouldn't that be helpful to make more money for this or that? And the puzzle, the challenge, the collaboration. And what happens is, the way I see the way you've laid out the book, was it becomes more of who else is at the firm. And some of these people wanted to work with these other people.
Yeah. So Charles, the secret to his success, the secret to why Jim Simons is the greatest trader / speculator in Wall Street history is he combines both sides of the brain. He's both a mathematician and world class. We're talking, I'm just going to read you a little something. I got to look at my email here. So we early in the book, we talked about the concept that's called holonomy. It's a topic, it's a concept in geometry, and I needed to understand it. Don't worry, readers. I don't get into it deeply in the book, but it is a sentence or two, and I had to understand it. If I'm going to write a sentence, I still have to understand what holonomy is. So I asked him to dumb it down for me. So hold on one second. I just got to find it for myself here. Sorry. Hold on. Sorry about that. Okay. So I said, hey, Jim, can you define holonomy for me? And he said to me, sure. And this is his email to me. If it is helpful, holonomy may be defined as parallel transport of tangent vectors around closed curves in multiple dimensional curved spaces. This is him dumbing it down for me, Charles. So the point being, he's this great mathematician, but he's also a guy who you want to hang out with, you want to have a beer with. He brings gin and tonics, he's smoking, he's got these chain smoking's merits. He's a funny guy, witty guy. So he's able to understand people, as you suggest. He knows what motivates them. And everybody's a little different. Some of these mathematicians and scientists need a challenge. Others, as you suggest, could use a little more money. Others just some combination. Maybe they want to see if they can beat somebody else there. Some people want to beat the market. There are all kinds of motivations. And he understands the most. So he's a great recruiter too.
Yeah. So he builds up a team, and it's not until 1990s where he starts to hit his stride, or a little earlier?
So I would argue that by 1992, they had mastered the world of bond trading, commodity trading, currency trading, but that doesn't get you so far. Those markets aren't that big, at least some of them, especially some commodities, et cetera. There's just so much money you can make, so much money you can manage. And he was this motivated guy. He wanted to be the greatest ever. And you can't do that managing, let's say, $800 million. That might be enough for me or for you. You can go still buy an island. If you make a lot of money with that $800 million fund, seems like a lot to me, but that wasn't enough for him. And it wasn't just about money, but part of it was motivation. He really wanted to make a lot of money, a fortune, so he could affect society. And we could talk about how he's doing that today. So the only way to do that is by mastering the world of stock trading, equities.
Because it's the deepest markets out there. It could absorb trillions of dollars.
Exactly. And they spent years working on that, using some of the same approaches, and it didn't work for various reasons. I write about it in the book. Their approaches weren't bad. It was the execution of the trades. In other words, they had these signals, what we call them. They found ways to make money. This stock would go up this way. And I think I want to emphasize this before we go any further. They don't predict stocks or anything. They don't predict necessarily where things are going. They bet on relationships between investments, between equities, between stocks. They'll do a little bit of predicting, but a lot of it is just relationships. This was going to go higher, or this relation is going to collapse, or it's going to widen. A lot of it is akin to statistical arbitrage. So Jim and his team, they found ways to make money potentially with stocks, but when they put on their trades, they were affecting the market too much. They were moving things around, shaking things up, and they were losing all their profits. It's a little bit like I write in the book about a chef who's got this great recipe, but every time he or she makes the food, whatever it is, kind of trips on the way from the kitchen to the dining room table. And but he recruited a group of people from IBM, speech language people. Bob Mercer's one of them. And they changed everything, and they figured out equities, and then they were off to the races. So by 1996, they had the approach that was going to change the world. And after that, they were just minting money.
Right. So I just want to put this in perspective for a second. He's born in 1938. So by 1988, right, he's 50 years old, they're managing only $20 million, which $20 million was not a lot of money.
Nope.
I think we were managing more than $20 million back in 88. So he's managing $20 million in his first year, 9% return. Nothing to write home about at all. 1989, he actually loses money, loses 4%. So he stays at $20 million, and then it takes a couple of years. So it takes him 10 years to go from 20 billion to $1 billion. So it wasn't straight up. There was 20 billion under management, 20 million, 30 million, 40, kind of crawled. So by the time, let's say he's 50, he's 50 years old.
So, 50.
So right, he's 55, 56 years old, and he's managing like $70 million. They're making money, don't get me wrong, but this is not master of the universe here.
Not at all. And like you had said earlier, many people, if not most people, probably would have given up. He had other opportunities, could have gone back into academia. He was doing some private equity investing. The firm is called Renaissance Technologies because they were like a venture capital firm as well as a trading firm, and they were doing better with venture capital. So many people would have just thrown in the towel, but they persisted, and he was in his 50s when he finally made it work.
Yeah, it's staggering. He starts his career when most people are ending theirs.
He becomes the greatest trader in Wall Street history, starting at the age or making it happen only in his 50s. It's kind of crazy.
Yeah, it's astounding. So as time goes on, computer models get more serious. They're more complicated. Computing power just continues to increase. And all of this time, he's never resting on his laurels. They keep getting a deep bench of smarter and smart. Do they have any Nobel Prize winners working for them?
Not sure, but they have a remarkable number of PhDs. The funny thing is today, everybody in Wall Street talks about their PhDs. Like I'll go on a tour, or before COVID, I'd go on a tour of a trading floor and they'd be like, Greg, over there is our PhD. Oh, sitting over there in that corner is our PhD. About a third, maybe even more of Jim Simon's firm is PhDs. So they were doing this stuff way before everybody else. And we're not just talking PhDs, we're talking about groundbreaking mathematicians, scientists, people from all different worlds, physics, etc. And what he does is he just hires in a very different way, and he manages in a different way. He usually, and now he's 83, so he's not running things day to day. He's got other people do, but they don't hire for need. They don't say, well, we need a programmer or a coder, blah, blah, blah. They just hire smart people. And they say, go figure out a way to improve our system. I'm jumping ahead a little bit, but there's so many ways they're different and unique.
Yeah, even the description of the office, where they work is pretty tight. The conference room is tight, but the cafeteria and everything is a lot of open space because he wanted collaboration.
It's all about collaboration there. Yeah, they're so unique. Yeah. They're more unique than everybody else. Everybody else on Wall Street is siloed. Even the quant firms, and I've talked to people that they're like, well, that guy runs this fund, and this woman and her team is over there. There's none of that at Renaissance. It's all one fund. They all, the Medallion Fund is the key fund, and they all work together on that one fund. And there are risks involved there. That means everyone knows everything, but as I kind of suggested earlier, they don't have to worry so much about people leaving.
But people did leave, and he made everyone sign a non-compete, a non-disclosure, except in this one case where it just slipped up on one, and the guy left and went to, I think it was...
Millennium.
Yeah, Millennium.
Izzy
went there, and there was a battle.
It was a huge battle. It was it rocked their whole firm. It jeopardized Jim and his team, what they were trying to do. Why was it such? Why did
I read that, and I'm just saying to myself, why was there such jeopardy there for him? Why did he think that there was?
Well, they listen. As well as they've done over the years. They, as you said, they're scared that it's all going to go away at some point. And they have an edge, but they have unique approaches too. And there are some things I write about, other things that aren't in the book that other people don't do. And they don't want anybody, they're a little bit paranoid maybe, or neurotic even, but they believe in complete secrecy. I mean, if I could tell you, there's so many times that they told me, not only did they told me they wouldn't talk to me, people at Renaissance, Simon's eventually talked to me, but he didn't tell me kind of secrets. I had to get kind of that stuff elsewhere. But at one point, I had a meeting with the top quant on Wall Street to talk about Renaissance and Simon's. And then he canceled the night before. And he's like, sorry, Greg, apologize. I'm like, well, why cancel? And he goes, well, Jim doesn't want me to talk to you. And I'm like, Jim's your competitor. Well, why do you care? Why do you care what Jim? No. It's Jim Simons, Greg. I can't offend him. It was like a mafia don, and you don't want to offend the mafia don. So there's this cone of secrecy about them. And yeah, anybody leaving, they're nervous about that.
Wow. Okay. So as time goes on, they become not only great, they become GOAT. They become the greatest of all times. The two competitors which come somewhat closer, I think, was D.E. Shaw.
Shaw's a great firm. They're not as good, but they're successful and quantity firm in their own right. Yeah.
Right, which Jeff Bezos started at as an analyst. So they too hired brilliant people, brilliant mathematicians, but they don't hold a candle to Jim Simons. Why is that?
There are a lot of reasons. Some of them are this open architecture and how they manage and the types of talent. Again, yeah, D. Shaw's brilliant people, but are they people who ran Stanford's mathematics department? Right. I'm sure they have PhDs from Stanford, but maybe not the guy who ran the department. So the talent's better at Renaissance. They also use more leverage. They use more borrowed money than other firms. And I talk about that in the firm. And for years, that was really a huge advantage for them. And they could do that because their returns were so good. So Wall Street gave Renaissance better terms, better borrowing terms than any other firm, including D.E. Shaw. And you can't understate the importance of leverage. There are times when they borrow a lot of money. When they sense there's real opportunity, they go for it. And again, their terms are just ridiculously good. They're not quite as good over the last few years. There's been more scrutiny of the lending to Renaissance, so they haven't been able to enjoy the same kind of terms. But for years, that was a huge advantage.
Yeah, I saw sometimes they were leveraged 12-1 on some trades.
Yeah.
Very low rates and all this. So that's a huge advantage.
Which frankly made it scary for them. The few times they had down periods, they didn't have long down periods. They've never had like a whole month or something. But there was a quant meltdown. There was a few years ago in 2008. Right. There were difficult periods. And as I write about the drama behind the scenes, when you're borrowed that much money, even Renaissance gets scared. Now it all worked out in the end, and they've got the data showing how these kinds of markets, how they can take advantage. And they usually do the best in those kind of markets. Those are the years they do the best, but it doesn't mean that they're not scared to death internally.
Because in 1998, you had long-term capital. They were the smartest guys in the room. You had PhDs. You had people who've worked on Wall Street, specifically in bond trading, like Merriweather worked for Salomon Brothers. And they go into a business, they attract oodles of money, unbelievable performance, and then they blow up.
Yeah, and people have always said, well, why hasn't Renaissance blown up like LTCM did? Aren't they similar? And I would argue that there are differences. And I've talked to people internally, and they were worried too. People at Renaissance are like, wow, LTCM blew up. Aren't they a little bit like us? And how do we make sure we don't blow up? Part of the problem was LTCM doubled down when things widen out, when the spreads widen, they put even more trades. The Renaissance models don't usually do that. They're a little more humble about their approach, the Renaissance people and their models, so they won't necessarily add money to their trades. They also use a lot of leverage, but not nearly as much as LTCM did. And one of the keys for Renaissance is they don't interfere with their models. Even if their instincts tell them they shouldn't be buying or selling at one time, they don't override the model. If the model says it automatically trades and it says to go long something and go short something else, they almost never step.
Yeah, almost never, because I remember there were a couple of times they did.
Yes, that was more when Simons was running things. Remember I told you he's a little bit like you and I to some extent.
He's human.
He's human, more so than his colleagues. Yeah. So his colleagues are much less human.
And then, by the way, you write in the book how they got pissed at him because he said, we're a quant firm and you're overriding it. And here was the market experiencing, I think it was it 98 or 2008? I'm not sure.
That was later, yeah. 2000, yeah. 2007, there was a quant meltdown.
Yes, when all the quants just got burnt.
And Renaissance's models said they should be buying. And Simon said, no. I'm nervous here. Let's pull back here. And they were really pissed, his colleagues. And frankly, they run it, now that he's not running things day to day, they run it only by deferring to their models. And their models, they would have made more money. So yeah, he historically stepped in a few times, and I write about that in the book, partly because it's more dramatic and it's more interesting when he did so. But most days they defer to their trading system. You
have something here that I'm jumping towards the end, but I thought it was so interesting, where here is a scientist with all the data who is, to avoid emotions. Oh, here it is on page 308. I thought this was rather great, where Simons is now out of the firm. He's now somewhat retired, and he has someone managing his money. Ashvin, I can't pronounce his name.
His family office, yeah.
How do you pronounce it?
Oh, I don't even remember myself.
Afshin
He's
a
guy running his family office, yeah.
Elucidine Capital. And Jim Simmons called, well, I think we should do this, that. And they got right. Jim Simmons and Renaissance showed it was possible, right? The goal of quants like Simmons was to avoid relying on emotions and gut instinct. That's exactly what Simmons was doing after a few difficult weeks in the market. It was a bit like Oakland A's executive Billy Beane scrapping his statistics to draft a player with the clear look of a star.
Yeah, so just to kind of paint the picture, the scene, basically the market's melting down a few years ago. Simon's on vacation at the Beverly Hills Hotel. He looks up at CNBC, things are collapsing, and he calls his broker, or the guy who runs his family office, like you and I might, and said, shouldn't we put on some hedges here? I'm getting a little nervous. And he told me that story, and I was like shocked. I was like, Jim, you are the pioneer of this quantitative approach, deferring to computers, systems, not instincts and intuition. And your intuition is telling you you need more protection here. How do you explain that? And he didn't pick up on the irony. I don't know. He was like, well, I don't know. I wanted to see we had enough protection on. But the point being, it's hard to be a quant. Even Jim Simons, the OG, the pioneer, the guy who developed a system that conquered the market, even he panics and gets nervous about the market and where things are going and says, shouldn't we be buying protection here? So, it just underscores why it's hard to hand the reins over to the computers.
Yeah, but that's to his greatness, is that he had this demon, which for quant trading, that's exactly what that is. Emotion is a demon. And it always look, the system, back in the day, I was a quant trader, but we didn't call it quant, it was technical. And the way we used to look at it is, you are a dumb clerk. You were paid minimum wage in order to just execute the order. Don't think. Thinking will cost you. And we never overrode our signals, never. And we used to go to conferences, and we used to hear people talk, yeah, I overrode it, and I missed out this move, I missed out this. Because when you override a system, you now have a new system with a one-day track record. Right, so all of the track record and all the system, it goes right in the toilet. You now overrode it. Never did that.
It's easy to say, though. Most people cannot pull that thing off. They used to wonder, well, why are we making so much money? And then they used to joke, but it wasn't really a joke internally. Well, we're trading on the other side of a lot of dentists, meaning, dentists are notorious for thinking they know a lot about investing, and they get a little emotional sometimes, and they take Renaissance and Jim Simons and the fund. They take advantage of people like me who would. I can't trade because at the Wall Street Journal, but I would panic and get nervous, or the greed also and the hubris of investors. And Renaissance is on the other side, ready to take advantage.
Right, and then when it doesn't work out your way and it goes down, you start second guessing. I remember those nights. I second guessed everything. And then I used to go back and just look at my computer models and go back and look at the history and saying, okay, I have 1 day of emotion and 50 years worth of data. What am I trusting? And I was smart enough at the time. We got out 2 weeks before the crash when I was a quant trader in 1987, October 6th. Yeah, it was looking terrible then, but we got out October 6th, and the market was down from August 25th to October 6th. It was not looking right. Our system told us to get out, and I
Oh,
definitely looked and said, "Oh man, there's going to be a snapback here, to the upside." And we got out, and we didn't get back until November time, and it made the business. We were managing a few
wow.
$1 million at the end. Yeah, we avoided Wall Street Journal, not the Wall Street, New York Times wrote us up, and it was a big deal. But it was the biggest deal was pulling the trigger. It wasn't the trade, it was actually getting out of the crash. That was great too. Don't get me wrong, but to actually take a trade when every emotion in you, every instinct in you rather, is telling you this is the wrong time. And those are the best trades, by the way. When everything feels terrible, those are the best ones because you're missing it.
Yeah. It's easy to say, but it's hard for people to pull off. I mean, I've been writing about smart investors since 1996 at the Wall Street Journal and in my books. And you'd be surprised how many of them have the same emotions as the dentist.
It's like I always said, here, it's like going to a surgeon, a world-class surgeon, and then when he's like faced with a real difficult surgery, he goes in and starts taking a rabbit's foot or he starts looking into a potion. You say, oh my gosh. But, humans are humans. We're people. And the hardest thing is to stick to a system. And I always looked at it, look, eventually I said the system has to constantly evolve. And that's why in 2000, I became more of a fundamental trader because I said longer term, I am not going to evolve as quick as everyone else was. And the systems were evolving much quicker. It just, back in the 80s, it wasn't so hard because few people were doing it. So if you had a rule-based system, you were doing pretty well. It was pretty predictable in terms of you do this, this is what will happen because very few were doing it. Very few were doing it.
Yeah.
That was the time WINS only had business news at 27 minutes and 57 minutes past the hour. And it was only for like 60 seconds. So it wasn't this constant flashing of the screen. So, there was a lot of opportunity then.
It's not just that. Today, the quants digest data quicker than you and I can even think about it. So be it an earnings report, be it something that comes in news, geopolitics, et cetera.
It's a different ballgame. Totally different
ballgame. They identify it, they read it, they trade on it before you and I have even thought about it.
It's trading nanoseconds. So it's totally, the game has changed. So I thank God I was smart enough to see that in 2000, 2001, that the game was changing. I said, I was always following Buffett. I said, enough. He's the greatest guy so far. Makes all the sense in the world. Let me get into that. And so that's what I was doing for this. But I was a technical, we wouldn't call them quants, we call them technical traders. And I used to farm out to computer guys who, people don't remember this, were younger, but very few people coded. Back then, there was no coding. Excel was pretty new. VisiCalc was before that. We paid people to go through reams of data. And we used to buy the data. It was very expensive because, like you said, clean data was very. And if you have data that was just screwed up with, it had a wrong high or wrong low, and your system was based on that, you had garbage.
Yeah, and that's one of the advantages that Renaissance always had. Their data is better than everybody else's. Lately, people have caught up. It's not as hard to get clean data going back decades or even centuries. But back in the day, no one was close to them.
Yeah. Okay. So now he becomes master of the universe. Jim Simmons, Renaissance, they just do absolutely amazingly well. And then he leaves the business. Well, he has tragedies in his life, this poor guy. He has a lot of, two of his sons, right? I think it's two of his sons.
Yeah, so to me, that's one of the lessons from this book, that you can make your fortune, make billions in dollars, predicting the market, and yet you're left flat-footed by what happens in your personal life. So yeah, he had two sons who died tragically, one in a bicycle accident and the other in a scuba diving accident. And it's just devastating stuff. So yeah, he in a personal level was much less successful. He's a happy marriage and his children are thriving, but he's also lost two children.
Sons,
yeah.
He writes, I think you quote him here, which is just was chilling. When he's mourning for his second son, I forgot his name. What was the second son's name? Who died? I forgot. Who's in a diving accident.
Nick, I think Nick.
I forgot, somewhere's about there. So he's sitting Shiva, which is the Jewish mourning period, and he says to someone who comes visit him, I forgot who exactly it was, but he says, "My life is aces and deuces." It's like all the greatness he's had here and all the tragedies you have here. It's like it didn't make any sense. I found that very ironic. Here's a guy, like you mentioned, predicted everything and broke the code, but the code of randomness in life
life.
No one gets around that one.
Which is a reminder.
Yeah, it's an attitude adjustment.
Yeah.
It's an attitude. So what does Jim Simmons do? How is he impacting the world around him and with all his great wealth?
So he took all those billions and he's dedicated himself to a few passions. One is education. So he subsidizes public school teachers in New York, science and math teachers. He believes that they don't get paid enough. There are too many of them leave for private industry, for firms like Renaissance. So he's spent years subsidizing their salaries. He's got an effort to help cure or find some medicines for autism. He's got some family in his family. Some people in his family are autistic, so he's dedicated himself to that, and they believe they're making progress in autism. We'll see what happens. Fingers are crossed. He's also spent a lot of money trying to figure out the origins of life, and he's got an effort. And we're talking spending maybe $100 million, some huge amount of money, trying to figure out the first moments of existence and whether the Big Bang is accurate description of what happened, whether or not. He's got some skepticism. He's working with someone who's a bigger believer. He's getting involved.
That's Brian Keating, right? A mutual friend of ours.
Exactly.
Yeah. So he was on the show also a while back, Brian. And so Jim is funding his efforts to find the beginning of time, the beginning of the universe?
Yes, he's the financing behind it. Yeah, so he's dedicated himself to that, and that could be the greatest achievement of his lifetime, Jim.
Wow, absolutely amazing. And does he have a son who's in the money management business too?
He manages some of the family wealth. Yeah.
Wow. Wow. Do you think we'll see another Jim Simmons?
Oh, I mean, there are people like Ken Griffin that are very successful. They do it differently. They're more of a market maker. They've got a hedge fund side to them too, but they also do market making and other kinds of investing. But in terms of just beating the market year in and year out, I don't know. It's a great question. And to the extent that they've done it, and they continue to do so. I mean, in 2021, the Medallion Fund was up 49% after those crazy fees, which are like whatever we said, 5 and 49 or
44.
Yeah, something crazy.
Wow.
So it's hard to believe anybody else can come close.
Wow. You know, you look at a society as a population as big as ours, you don't have dozens of these. You got one guy, one firm in a sense. And look, the other firms are there, but nowhere near to the extent when, look, most people don't know about Jim Simmons, and most people don't know about his and they want it that way, right? They want it that way. I'm sure people, when you came out with this book, they weren't too happy. Not Jim, but all the other folks, because here you are with, pulling back the curtain on a company that really valued to the extent of paranoia of their secrecy. They did not want anyone. So you don't hear about them, but you look at the other firms, and when you looked at, I put in comparison in the back of the book. When you look at George Soros, you look at D. Shaw, you look at Ray Dalio, for example, Warren Buffett. These guys are like way out in front.
Well, there's no comparison in terms of the returns. Now, you can make the argument that Simons and his team, they don't manage as much money as, let's say, Buffett. Buffett is huge, it's enormous. So maybe it's not fair to compare with Buffett. I would argue that Buffett didn't have to get so big. Right. Simons keeps giving money back. So in other words, that their key fund, the Medallion Fund, right now is about $15 billion. For years, it was $10 billion. And they consciously, all their profits each year, they give back. So they start over every year at that original number because they don't want to get too big, because they don't want to have to use their third and fourth best ideas. They want to go with their best, only the good ones, et cetera. The market is getting more efficient. So that's another reason to think that you won't get these kinds of returns. Information and news and such a news flow, it's just a much more efficient market. When you talk to some of the smart people on Wall Street, it's gotten harder to make money rather than easier. So that's another reason to think you may not get anybody like him again.
That's why, just in my humble opinion, the game is not on the short term, because that became too smart and too crowded. It's really the edge is the longer term, because few are looking there.
I write that in the book. So I don't think people should be trading short term for lots of reasons. But one is you don't want to go up against Jim Simon and his team. You'd rather go up. They're not doing long term investing. Just so people understand, they trade, they call it internally moments to months. So they don't hold anything for years. So if you and I can, we've got an advantage, I think.
Yeah, amazing. I've been calling him Jim Simmons, huh?
A lot
Jim
of people
Simons.
do.
Yeah, Jim Simons. Yeah. All right, a lot of people do. But all right.
You're not the only one.
Yeah, no, I want to tell you a great book. Really, really. I read this in like 1.5 sittings. I sat, I read this right after the show back, I don't know how many months ago. I left it here, and then I knew you were coming on the show today, and I just read the whole thing yesterday, I think half of it, and it's just really a great read. It gives first of all, it's fast-paced, a lot of players, a lot of human emotion. It's really like a drama. I like to see this made into a movie.
Yeah. I would also. So if any of your audience wants to reach out, let me know. Yeah, the characters are just fascinating. I was a little worried starting the book. It's a bunch of mathematicians and scientists. How much conflict can there be?
Oh, but there's a lot of conflict, man. They're crazy.
Oh, my gosh. Oh, my God. What the money did to them, how it tore them apart, what politics did to them. One supported, helped put Donald Trump in office, and then others hated Donald Trump. So it split them. And then two, there was a lot of conflict and emotion behind the scenes within the firm. So these are real characters. Yeah.
Yeah. Wow. Greg, once again, man, you just keep knocking the cover off the ball. What's your secret? How do you keep finding these great ideas to write about?
I just look for quirky, interesting people, a lot of interesting people out there, and I'm fascinated by them. So I'm always looking for people that achieved big things and have outsized personalities. And I kind of delve into how they did it, how they pulled it off.
You have another book in the works, or are you taking some time off after?
Take a little time off too. My last book, A Shot to Save the World, was a difficult one, and I'm still kind of publicizing that one and giving speeches around the country, audiences and such. So I'm doing some speaking around the country for this book as well, for The Man Who Solved the Market.
How long does it take you to write a book like this with all the information? Is this years?
A couple of years, but frankly, it should take longer. We're talking. I go to bed on average around 3 a.m. when I'm writing a book. It's just intense. I'm just pushing. I'll sleep on the Sabbath, and then I'll start over again. So it's intense. When I get caught up, you can talk to my family. I'm very caught up. It's all in. It's all I think about for a year and a half, 2 years. So it's all consuming. It's a difficult process, but I don't know. Once I get into it, I get consumed by my subjects.
Yeah, no, I wrote one book, nowhere on par with yours, Getting Started in Value Investing in 2007 for Wiley. And it was a year of, because I'm similar to you, very intense. It has to be perfect. Every footnote has to be attributed properly. I found so many quotes and so many mistakes that people were just carrying over from book to book. So one day I just spent, I remember it was 8 hours finding the correct quote of something because it was misquoted in 20 different books. It was just absolutely staggering. So
we say in our business, writing is rewriting, and you're just rewriting all day long.
Same thing. And so after that book, I said, I'm never going to write another book. It tears the guts out of you, and you can't sleep because you're just always thinking about the subject matter. I was thinking about markets. You were thinking about personalities, so it's much, much harder and nowhere on the level, but I totally get what you're saying. To do this 4 times and do it well, wow.
Yeah, and I did two books for young people. Frankly, like as much as I've enjoyed the books and I have enjoyed writing them, they're so hard that they're worth doing, but they're just barely worth doing because it's an emotional roller coaster and it's difficult. And some people won't talk to me, and I got to get them to talk to me. Then, you don't want to put me on a couch, so I can.
Dave Cody, former CEO of Honeywell, he wrote a great book, and we had him on the show a while ago. And he says, I'm never writing another book. He goes, first of all, you figure out how many hours I was getting paid, like 35 cents an hour to do it. And secondly, it just tears your guts out. It has to, those are people who care about what they put out. If you don't care, you'll throw out garbage or regurgitate something else or just, repurpose it. But if you're really writing new stuff, but there wasn't anything on Jim Simons and then
half the time, people write books and barely anyone reads them. So it could be a difficult process.
Yeah, well, you've balanced that, man. Really great. Greg, once again, man, all the power to you and lots and lots of success. The name of the book, folks, the name of the book is The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. If you're interested in markets, you're interested in math, you're interested in just human beings and how they deal with stress, it's a phenomenal book. Really great. Greg, thanks for coming on the show.
Oh, it was a lot of fun. Thank you for having me.
Thanks for listening to this episode of The Charles Mizrahi Show. If you're a new listener, welcome. If you've been listening for a while, we're glad to have you back. Either way, we'd love to know what you think of the show. Please leave a review if you listen on Apple Podcasts. Reviews make it easier for others to find the show. You can also see the video of the interview on the Charles Mizrahi Show channel on YouTube.